What's up, you guys? It's Michael. Recessions can be a once-in-a-lifetime opportunity to create massive wealth. Watch until the end to learn the one thing most economists won't publicly say about inflation. As they say, riches are created in recessions. It's not hard to see we are increasingly getting closer to that point. Look at the news. Today, even just skimming the news, I'm sure you've seen several headlines surrounding recessions. 79% of executives expect a recession, and only 35% of them feel prepared. Popular companies like Google are even slowing down amid recession fears, and almost 2/3 of economists think the economy is in or near recession. Even though this sounds negative, recessions happen way more often than you may think. Even just by looking at this, I'm sure you can see how you can set yourself up for life if you play this right. Generally, recessions are a trend of simultaneous failures of business and investment plans. I'm sure you can see how we got here, with the Federal Reserve raising interest rates and the COVID-19 pandemic creating supply shortages and with stimulus money. Nicholas B. Creel, who serves as an assistant professor of business law at Georgia College and State University, said in a Forbes article that much of the inflation we have today is caused by rising gas prices and supply chain issues. He said that by sending out stimulus checks, you increase aggregate demand. Increasing aggregate demand in an economy with a low supply can create more upwards pressure, in turn raising inflation, especially considering that most people spend stimulus checks fairly quickly. The general definition of a recession is 2 consecutive quarters of negative GDP growth. According to Investopedia, when this happens, private businesses often scale back production and try to limit exposure to risk. Levels of spending and investments are likely to drop and demand will begin to slump. When recessions hit, people are up against high unemployment rates due to the layoffs to save money. They're also up against higher interest rates and loss in consumer confidence. Recessions can also kill stocks and a decline in stock earnings. Companies report earnings for every quarter. They also give guidance on upcoming quarters, and as people begin to earn less because of loss of jobs, they begin to spend less. Bank of America even warns of the possibility that the economy is going to start losing 175,000 jobs a month. Now for the positives. Recessions can create massive amounts of wealth if played right, whether that be in real estate or stocks or sometimes even holding cash. If you look at the S&P 500 or the NASDAQ, you will see that we are down a considerable amount right now. But some will say, Michael, we have way lower to go and you're just trying to catch a falling knife. Time and time again it has shown that everything is just on discount. My favorite quote by Warren Buffett reads, "In short, bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price." As Yahoo Finance points out, the S&P 500 has a median 24% decline during recessions. But then 1 year after the trough, a 39% return. And then another year after that, a 58% return. Now for the thing that all of you have been waiting for, what most economists won't say. To put it straight and simple, to reduce inflation, the economy needs a recession. Every economist knows this, although few will publicly say it, said David Moon. To reduce consumer prices, we need an increase in the supply of consumer goods or reduction in the demand for those. Increasing supply would take too long and there could be more problems along the way. The only relatively quick way to reduce prices is for people to quit buying so much. This is why there are rate hikes to come. It helps cool the housing market, and it helps cool the amount of money people will begin to borrow, whether that be through credit cards or loans. Thanks for watching my video. If you want to learn more about personal finance, motivation, and discipline, click here.